This is you. This is you trading. This is you deciding whether to hold or sell. This is you trying to predict whether the curve is going up or down. Fun fact, you can't. It's impossible to know unless your name is Nancy Pelosi, in which case I'd be very surprised that you're watching this. I'm guessing, if you click this video, it means you've probably lost an unimaginable amount of money, like me when I lost my entire fortune of $30,000 at the tender age of 17. This video is not gonna make you a financial genius, but it can make you avoid some of the most significant pitfalls in investing. Are classic trading platforms weird, complex, with a steep learning curve? No problem. Gamification. Now it's easy to see what you've earned, no need to place sell price or number of stocks. You can even copy other traders without doing any work. Think they know how to earn money? Go for it, boss. This gamification also causes your brain to think it's less real money. Kind of like why casinos use chips. It's simple and fast, so you will also make more transactions. Big win for the casino. The broker. But remember, it's still real money and not just green and red numbers shining on your screen. Second tip. Loss is weighted higher than gain. We're approximately 2.5 times more sensitive to loss than gain. That means the relation between loss and gain is asymmetric when there really isn't a reason it should be. Imagine you just bought a stock for $1,000. It rises 2%, which means that you made $20 profit. Immediately you cash out because you're afraid if it falls down again, you've essentially lost $20 you could have had if you had just cashed out. Oppositely, if it falls 2%, you're now down $20, but you don't sell it because you don't want to realize your loss. Instead, you hold your position, hoping to regain what you've lost. This is a huge human error because you should treat gains and losses equally, but you don't. eToro and other platforms capitalize on this. Green number, monkey brain go wee, and you take the sure win. Red number, you wait for it to turn green because you technically haven't lost it before you sell it. Don't make this mistake. Treat losses and gains equally. Third tip, the sunk cost bias. A year ago, you invested $1,000 in a stock, and its value is now down to $200. You already feel like you spent money on the stock, so it would be a shame to sell it out and realize your $800 loss, right? It's just going to bounce up again if you wait long enough. Well, not really. Oftentimes it just fades out in the background and eventually delists. So standing in this situation, ask yourself, with the current value of your investment, would you buy your stock today at its current price? If you had $200, would you spend that $200 on that particular stock right now? If no, then sell it faster than your parents throw you out the second you turn 18. If yes, then this might actually be a good hold. Fourth tip, don't trade with your emotions. Negative emotions are far more prescriptive than positive emotions, and this means that fear installs some kind of urgency inside of you and urges you to act immediately. Hey, don't fall for it. Just stop up for a second and consider, am I buying Tesla because I'm afraid that I will miss out on all the potential gain in the upcoming months? Or is this genuinely a good buy? Also, don't let your overconfidence lead you. Just because you made 20% profit in a month doesn't mean you're suddenly a trading genius. You didn't know that Nvidia was going to explode, you were just lucky. Number 5. Avoid priming. In situations filled with high uncertainty, we often turn to imitation of others. If you see another random guy writing in a Reddit comment, buy SLGO, it can only go up, it probably affects your decision making. But Plonk Me Warren 31 could have pulled it out of his ass and you wouldn't know it. Why would you trust him? What about that successful finance guy? He's had some success in the past, he must be right? But wait, is there a reason he's saying that? Does that leading finance guy just want a quick easy buck before he cashes out? Because he knows all the random people on the internet will follow his advice and lift the value? Just keep a bit of critical thinking, please. Remember that in an article by Forbes, monkeys throwing darts at random stocks performed better than experts in the stock market. Sixth tip, avoid confirmation bias. If you do choose to turn to the dark side of the internet, Reddit, it's important to look out for certain biases. 1. Don't look for views that only support your initial gut feeling. If you hope and think that Palantir is going to the moon, don't just look for assurance that you've made the right decision. Look for the critical perspectives. Instead of 1,000 people screaming it will go to the moon, look at the guy saying Elizabeth Holmes maybe didn't invent a revolutionary blood testing device at age 19. This just might save you $600 million. 2. Just because you've seen the name of a stock 20 times in the past 2 days doesn't make the stock more credible. Got it? Good.